Happy New Year to all. As we turn the chapter on 2023, we are faced with the constant dilemma of what have you done for me lately? To rest on the laurels of 2023 does little help anyone on their financial journey to create the best life for themselves possible. Last year was a great year to be sure. The Magnificent Eight had a continuous run and ended up being the small group of huge companies that pulled the markets higher for the year. Besides the late October of year-end advance being truly impressive and leaving many non-believers flat-footed, we noticed a widening in the number of companies joining the rally party, and this is the best vote of confidence for future continued market advancement that could have been hoped for. So what is next? What should 2024 provide? These are the questions that I will attempt to tackle this week and into January, as January tends to set the stage for the remainder of the year if historical precedent and statistics are to be used as possible future road markers in the market's travel forward. After a challenging 2023, we expect 2024 to be a mostly easier market to navigate, with positive tailwinds building. Some of these tailwinds I list later, but I want to stress that caution is still, as always, warranted as we are coming off a very aggressive upside move from the last weeks of 2023, and a digestion would not be unexpected prior to a continued up move. Foremost, consider this positive combination of fundamental tailwinds in 2024, falling inflation, like a rock. If inflation was the root of the Fed raising rates and the cause of the market's decline in 2022, then the opposite should hold true, now given earnings growth remains positive. Dovish Fed, managing a business cycle, not hammering inflation. It must be remembered that the inflation fight was one with excess money supply, not an overly robust business environment. This was very different. Falling interest rates benefit consumers, corporations, and stock market valuations. Positive investor inflows equals expanding market breadth. Smaller companies in lagging sectors for the majority of the 2023 advance have begun to move positively. This is a good thing. Doesn't this feel like a formula for rising markets? In our view, the answer is yes. There are many investors who were skeptical in 2023, and we think they will be forced to change their opinions going into 2024 as well. Plus, if Europe and China recover, this adds to the broadening upside. Europe depends on the U.S. for our consumption. China depends on the U.S. for its labor and manufacturing needs. Should our economy continue to progress at a measured pace, this could prove to be very helpful for the rest of the world. Keep in mind, we expect stocks to do better in 2H. One factor is reaction near highs, as stocks making new highs then consolidate. As we have noticed on the first trading day of this week, it is not uncommon for companies that have advanced a lot to experience some profit taking after the end of the year for tax reasons. We expect new highs in January 2024 and sometime in 1H, a consolidation. If election year precedent is any indicator of this year, you can see in this chart that the first couple of months of 2024 could be a slight shuffling of the deck and not a continuation of a straight-up advance. Seasonals in election year mean stocks tend to peak in February and consolidate into April. Again, take a second look at the chart here to give some level of expectation for the beginning of 2024. Investors might get anxious waiting for Fed cuts in 1H, and this could lead to turmoil. I bring this up as a potential reason for the first quarter digestion. The media tends to want to hang their hat on reasons why, should there not be any other major flare-ups in the international scene or some other domestic black swan, the interest rate boogeyman could be the one that the media could choose to hang their hat on. But this does not mean we are on the sidelines in early 2024. The opposite is the case. A strong December 2023 implies solid gains into January and February 2024 before the earnings reports and forecasts are released, creating a trough in corporate news flow. When December is greater than 4%, like 2023, January boss. February gains average +2.6%, a 73% win ratio. When December is less than 0%, not the case, January plus February gains average +0.9%, a 50% win ratio. So to end this list of bullet points, a strong December tends to bode well for further gains. a decent base case is a 3% rally into the end of February or mid-February. But if the first week of January proves to be a negative one, this progression could be challenged. If this proves to be true, then I will, of course, take the time to explain a change in expectations based on continuously evolving facts. The facts of this first week of January measure are: keep in mind the year plays out in the first 5 days. This is the rule of first 5 days. When prior year is greater than 15% and January is positive the first 5 days, this equals day 6 to year end up 11%, a 78% win ratio. When prior year is greater than 15% and January is negative the first 5 days, this equals day 6 to year end down 2%, a 50% win ratio. So a January 8th close positive year to date could be key. Why does the first 5 days of January tend to matter so much? We think this reflects market dynamics early. This was the case in 2022 and 2023. And as such, if we get a negative first 5 days, this could negate our call if January first 5 days is weak. There is one other thing that I am paying particular attention to. This might take you a bit into the weeds, but I think it is relevant to share with you all the same. The expanding breadth statistics have not yet begun to turn down meaningfully in a way that merits attention. I say turn down meaningfully, but what I really mean is that the last week of the year the market didn't get negative, it just sort of took the week off. It didn't get particularly tired, it just bounced along sideways without anything major happening in either direction. One gauge I often employ for breadth is to study the 10-period exponential moving average of advancing issues divided by advancing plus declining issues. As can be seen here, during times of market weakness, this gauge tends to drop ahead of time and begins to turn lower, diverging from its peaks. Similarly, ahead of market advances, this gauge normally will begin to show positive divergence and begin to trade relatively better from a low level. At present, this should be something to watch carefully in the weeks to come, as it will likely begin to turn down, most likely ahead of the S&P 500 beginning an eventual consolidation. At present, this has shown steady gains from October, and while some brief sideways consolidation has happened over the last month, it has not begun to turn down in a meaningful way. I'll be following this in 2024 and will give it greater attention when it begins to turn back lower. It is clear that we have sort of entered a wait and see sort of period, a period where there is a calendar line to follow, an immediate past to observe, and many historical and statistical data points to respect. I don't pretend to have any allegiance to any one of these. I only hope to be on the right side for longer and the wrong side for shorter. All of us at Tower 68 wish you all the best for 2024. And again, please always feel free to reach out should any individual questions arise.